Good afternoon, everybody. Welcome back to the Opportunistic Trader. It is noon on Halloween, and we're joined now by Standard Grain's Joe Vaclavik. How's it going, Joe?
Doing good. How are you?
Good, good. We were just talking for a second that ags were active a few months ago, and especially when the global markets weren't really moving a whole lot, ags were moving around a lot, and now more recently we've seen a lot of volatility in equities and other markets, and ags aren't really doing a whole lot right now. What do you take from that?
Well, if anything, we've seen, during the last few weeks since mid-October, we've seen some downward movement in the soybean market and also in the corn market. But that was following a recovery that really lasted from mid-September through mid-October. So we're really kind of, toward the middle of where we had been in the corn market and in the soybean market. And those two markets in particular, volatility has been pretty low. If you look at the option statistics, we're just in a market that's priced as if we're not going anywhere real fast. The wheat market has probably been the biggest mover as of late. We carved out some fresh contract lows and some of this stuff last week, and we may do it again here this week. We actually had a positive headline in the wheat on Friday. We sold some wheat to Egypt, and Egypt is the world's biggest importer of wheat, and they hadn't bought any wheat from the U.S. since May of last year, I believe. So they bought one cargo of wheat, which is nothing. It's not enough to put a dent in the balance sheets, but it was seen as being a positive headline. So we rallied on that a little bit last week and into this week. What happened after that was the Russian prices came down. Everything in the Black Sea kind of went down. They didn't like that we caught some of that business, I guess. So now you got a wheat board that's got to compete with these overseas prices again, and to do that, we've got to go lower.
Yeah, one interesting thing about wheat that I've seen, we've Adam Collins on talking about the CO2 report all the time on Mondays,
Mhm.
and wheat for months and months now has had a spec long position. And a few months ago it had that rally up to above $6, and then it's come all the way back down. We're under $5 right now, which is a significant move percentage wise. But the spec long's not as long as it was a few weeks ago, but it's still in there. And I don't know. Do you think somebody knows something? Is there, or is that just a position that's waiting to be washed out? What are your thoughts there?
Well, it depends on how you categorize the spec position. So, in the wheat, we've got three different products that we trade. We trade the Chicago wheat, which is SRW wheat. We trade the Kansas City wheat, which is HRW wheat. The funds have still and do still have a long position in the Kansas City wheat. They're short the Chicago wheat and have been for a couple of weeks now. So I think at some point in time, and maybe still, there are probably some traders who believe that we're going to start to see better export business. And if that's your narrative, then you've got a story and you've got a reason to be long the wheat market. I don't know if I see it. I don't know if I see the exports improving enough to justify a long position. It's very difficult to be long the wheat market because of the carry structure. The CME has this variable storage system, and essentially what it does is it allows the carries to be much larger than they would under normal circumstances. So, say you're long December Chicago wheat here, the board's at 495. We're going to come up on first notice day here a month from now, and you're going to look out and you're going to say, all right, I've got to exit my December long, and now I've got to buy March. March board's 15 16 cents over the D's board, and the May board's even worse than that. So the carry structure makes it very difficult for any sort of speculator to stay long the wheat market. It's actually much easier if you're short the market to stick with the position, because you're able to roll it and actually pick up that carry every month. So it's a difficult spec position to maintain, and they've done it for a while now in Kansas City wheat. But these whenever they have to roll it, it's not helpful by any means.
Yeah, yeah, absolutely. And so what's wheat, like DC 19 wheat trading out right now? Do you have that up by chance?
Yeah, we've got big carries in the market. So just for a frame of reference here, December Chicago, the nearby 18, we're trading 494 on the board. December 19 is 559. So you've got what, 65 cents a carry basically for a year. That's a lot of carry in that market. So it makes it very difficult like I said, it makes it very difficult to stay long. A lot of times what happens in these sideways or bear type markets, or well supplied markets is probably the best way to put it, like we've got it in the wheat right now, is you'll see your spot month contract go off, and then you'll see your next contract kind of gravitate back toward where that previous contract expired. And if that repeats itself here, we'll see December futures go off, say at 495. We'll eventually see the March futures kind of drift down to that level. So it makes it easy to be short and much more difficult to stay long.
Yeah. So what are the near-term catalysts that we've got going in the ag space? It's December, or it's October 31st right now. For the month of November, what's on the docket that could really move the markets?
Well, your first thing is the November 8th crop production report from USDA. There could be a number of changes. I think the big ticket items there will be the national corn yield for this past year for 2018, and also the national soybean yield. A lot of traders expect that those numbers could come down a little bit. USDA reduced its corn yield estimate in October. Some people feel that they may do so again here in November. Soybean yield went up a little bit in October, but some people believe that because we had some nasty weather throughout the country and throughout the Corn Belt during the first part of October, that we may see that number come down as well. So the yield numbers are probably your big ticket items. The other thing that's maybe even more important would be some of the demand numbers in the soybeans. This U.S.-China trade war has just caused nothing but problems for the demand base for soybeans. And USDA reduced their export projection drastically back in July. I don't think they reduced it enough based on the export activity we've seen so far. It's been very, very weak. And October is usually our best month for soybean export sales. So USDA may have to come down by another a big amount in regard to exports in this report. I don't know if they're going to do in this report. They could gradually walk it down. They could make one big reduction. I'm not sure how they're going to do it, but I believe that they will do it at some point in time. Other than that, the South American growing season is kind of just getting started. So we're not getting too excited about that yet, although we will begin to watch South American weather a little bit more closely here in the coming weeks. And then this G20 meeting, if President Trump does meet with Xi at the G20 and they were to make some progress, that would obviously have huge implications for these ag markets. I think most other traders, I think there's very little confidence that we're going to make progress on that front.
Yeah. What about soybeans? They were really volatile, had a big drop in the summer months, and we've done relatively nothing the past few weeks. Anything there, or is it really waiting on China? What's the story there?
Well, the China thing is the big story. I think in terms of sentiment, in terms of attitudes, in terms of the balance sheets and what I see happening here, this is one of the most bearish setups that I've seen in any of these grain markets, probably in my career. It might be the most bearish setup I've seen, just because I think it's almost a guarantee at this point, barring some sort of resolution with China. It's almost a guarantee that USDA is way too high on exports. It's almost a guarantee that we hit an all-time high in regard to U.S. Soybean carryout. It's just a bad deal. How do you fix that? There's a couple wild cards. You could run into a South American weather problem. If that's the case, and they have a major production issue, that could help to rally the market. If we reach a resolution with China and China all of a sudden decides they want to buy U.S. beans again, that could be a catalyst for some upside movement. If soybean acreage in the U.S. drops more than expected in 2019, that could be a catalyst. We're not going to know much about that for another, 5-6 months. But that's another thing that can move the needle. But gosh, I'll tell you, it's one of the most bearish setups I've seen. I think a lot of people believe that the market's still overpriced, just on a fundamental basis. When you look at the expected supplies, the expected stocks to use ratios, the fact that China is projected to reduce usage. China says they're going to reduce usage by a lot more than what USDA has told us at this point. It's a really ugly looking deal.
In our months of speaking together, that is the most bearish I've heard you really talk about, or biggest conviction, I'd say, of anything that I've heard you talk about. You sound very pessimistic.
Well, here's the thing. Everything about it is bearish. Does that mean that I think prices are going to go lower? I think that's a different question, because this news, everything I just talked about, we've known this for weeks, for months in some cases. So is this just an instance where, the market's close to 10-year lows, the funds don't want to extend their short position, the risk to reward is bad? I think you can make that argument. I don't know if I necessarily want to be really heavily short this market as a speculator right now. I mean, there may be some money to be made, but gosh, all it'll take is one headline and you'll see a sharp rip to the upside in this thing. I don't know where that headline is going to come from. I think that the fundamental setup and trading the actual market are two different things. Just because I see nothing but bearish fundamentals doesn't mean I want to be short the market necessarily.
I'm looking at right now. I have Novi beans and Jan beans, which are both within 10 cents of each other, basically 840 in the Novi, 853 in Jan. Where is Novi 2019? I don't have that in front of me. Do you have that up by chance?
Yeah, Nov 19 beans are 905, which it's kind of similar to the wheat market in that you've got a market that's really oversupplied, and because we're oversupplied, we've got a ton of carry. The market doesn't want the beans now. They rather have them later. If anything, this is what happens when you get into markets that are really oversupplied. At $9 futures price, and you got to assume basis implications. Farmers are looking at like an $8 to $8.50 cash price for fall delivery in 2019. That just is not going to cut it. So because of that, if this price structure stays the same, these 19 corn at $4 and Nov 19 beans at $9, you're going to see, in my opinion at least, pretty significant acreage expansion in corn and a pretty significant acreage decline in soybeans next year.
All right. Joe Vaclavik, Standard Grain. Thanks a lot. A lot of great information there. We'll check back with you next week or the week after that, but keep us updated in the chat. We appreciate you taking the time.
That sounds great.
All right. Thanks, Joe. Talk to you later.
Yep. Bye.